Hello guys, and welcome to the Accounting Buddy. In this channel our focus is on financial accounting, auditing, taxation, and everything to do with management accounting. Now if you are interested in any of these topics, do hit the subscribe button so that you don't miss out on any future videos. Today we're going to be looking at a very interesting topic in cost accounting, which is margin of safety ratio. This is the amount or percentage by which the sales revenue may decline before losses can commence in a business or a company. Now, this topic should not be studied or looked at in isolation. Please refer back to the previous videos on contribution and break-even points. The link are there on your screen so that you can follow up nicely with this topic. Now, our margin of safety ratio consists of the following elements. It's actual sales minus break-even point divided by selling price per unit. Now, I do have to stress this part that the breaking point also has its formula, so please refer back to the previous video. I put the link above there on the screen so that you can understand the break-even point. But just to elaborate a little bit on the break-even point, this is the point where sales where sales and costs are equal. So at this point there is no losses that are being incurred and there's no profit that's being incurred. In economic terms, this is where we call a point of economic profit, where there are no losses or gains being made. So please look at the previous video. I put the link on the screen there so that you can understand and follow well with this video. This is a brief video, guys. Now we're going to look at the margin of safety in a typical example. Our MOS is margin of safety in units. Say we have total sales of 1,500 minus break-even sales in units, right? That means we had a total sale of 1,500 units and we only needed to break even at 1,000 units. This is where our costs would have been equal with our sales, economic profit, as I mentioned, which gives us 500 units. That's our margin of safety in units, right? So now we're going to look at margin of safety in terms of value. It's total sales minus break-even sales. This is just like the formula that I showed you before, the one on top. The only difference here with this formula is that now we are now speaking in rand value. This is in rand value or currency value, whereas the margin of safety in units was exactly the number of units. So if they ask for the margin of safety in units, you can use this formula, but if they want the monetary value for those units, this is where this formula has to come in, right? So our units, our cost of those units for 1,500 units is 75,000 rands and 1,000 units is 50,000 rands. This is just a typical example that I made out. So that means our margin of safety in value is 25,000 rands. So now this is how you calculate your margin of safety, either in units or in value, right? These are the minimum amount of units that one has to sell, right, before the losses can commence if you sell below that. So if you sell 499 and below, yeah, the losses will start to be incurred in that business. Now guys, for academic support, I do realize that some of you might have individual queries. Do leave the comments on the comment section, and you can follow us on our Twitter handle there. It's at Genie Accounting. That's where you can find me, or alternatively you can email me and I will respond promptly. I hope you enjoyed this video, guys. Next up I'm going to be looking at job costing, process costing. So the past few lessons have just been a build up to the main topics, and also direct and absorption costing using FIFO and weighted average. Now guys, thank you for the support, and